Predatory lending here in Canada. Should we scrap 5-year term mortgages and move to 30 term like they do in the States? All this and more with our good friend and mortgage broker, Dion Beg, right after this. Yes, my friends, as promised, here we are with Mr. Dion Beg, our favorite mortgage broker. How you doing, my man?
Hey, Gary. Fantastic, man. How you doing?
Excellent, excellent. One might say, how can you guys be doing fantastic when the market is, the sky's falling, as it were? But you know what? It's a beautiful sunny day here in Canada, and I'm happy. I got my health. I mean, what more could you ask for, right?
I think it's just a belief in a better tomorrow. That's why we all wake up in the morning, right?
A belief in better tomorrow. Okay, our podcast is now done. We'll see everybody next week.
Rebranded.
That's right. That's right. That's right. There are some interesting things coming out of the U.S. and the Canadian mortgage market follows the bond yields, and there's all sorts of crazy stuff. And I have a comment for Dion as he after he explains what bond rates and how they affect our mortgage rates and so forth. So Dion, take it from there.
Yeah, sure. So, a lot of us are watching the Bank of Canada and have been watching it for a very long time. And they meet, I think it's 10 times a year. So it's not every month, but pretty much every month. And so all of us for the last 18 months have been watching. And that's the Bank of Canada, and that impacts the variable rate, right? So everybody by now probably knows that. But separate to that, we have our fixed rate mortgage holders, and fixed rates exist. And they're impacted by a different thing called the bond yield. Now, if you just want to let me share screen here, Gary. So the bond yield is basically a prediction of the bond traders about where they believe the direction of the economy is going. Okay, that's what the bond yield is created from. And so even though the Bank of Canada interest rate increases only directly impact variable rates, they do invariably impact the fixed rates in the view that people have about the future, right? And so what I've got on screen here is the 5-year bond yield. And this is just a 3-month snapshot. So I just want to point that out. It's just the last 3 months. But in the last 3 months, what you've seen it do is move from around 3.3. And we broke well above 4, which was always a point of resistance that everybody was watching. And we broke through that. And earlier this month, just a couple of days ago in September, we were at over 4.3. So we moved a full 1% over these last 3 months. And anybody who's watching fixed rates has probably seen that as well, right? If I just move on to this next slide, again, it's the 5-year bond yield, but this is over a 10-year period. So over the last decade, you can see how that rate has moved. And if we go back 10 years, you can see that over here, we're starting at just under 2%. As things progressed, we very rarely broke above 2%. And then as of the last couple of years, we've been surging 2 to 3 and now above 4%. So needless to say, Gary, a lot of the people who are getting mortgages today are even more surprised today than they were 3 months ago at how high fixed rates have moved. And again, that's impacting people's decision to qualify, their ability, their affordability factor as well. And we are seeing the impact of this, again, reduce the amount of money that a person can borrow, because they need to now prove that they can manage that borrowing in today's market, where rates are at least 0.5% higher than they were just 2 to 3 weeks ago.
Yeah. Yeah, that's interesting. And what's really interesting is I heard something the other day, or I was reading something the other day, and it was talking about the bond rate. And in 2008, we'll call it the real estate bubble. We can call it a bubble because now it's, a decade more later, we can really analyze the numbers down in the States. And the interesting thing there is when that bubble or that financial crisis happened, what happened with the interest rates in Canada? They went down, which created opportunity, not only locally, but across in the States. What they're saying now with this potential financial, they're not quite ready to call it another recession in the States, but they are very mindful of what's about to happen over the next 6 months. the gurus, as it were, the financiers, as it were, are suggesting that rates won't come down in the States during this time. So it'll be interesting to watch and how it affects not only the U.S. but the Canadian economy as well.
But it is exactly those same gurus that affect market sentiment about the future, including these bond traders and how they feel rates are going to be. And so they're basically agreeing with what you're saying there in that, look, if the bond yield is where it is, it means that they also believe that things are going to be higher for longer. And actually, if I just spend a minute talking about the Canadian and USA relationship in regards to interest rates in real estate, something to remember is back in 2008, when we had our global financial crisis, the US economy took a huge hit and house prices across the board dropped by about 25%. That was pretty much, and in some cases, 50% or more, right? But across the board, it was at least 25%. At the same time, Canada didn't have the same negative impact. We dropped by about 10 or 11%. So it wasn't as bad. More importantly, though, is the recovery. So while it took the US somewhere around 8 to 10 years to get back to the numbers that they were at prior to the global financial crisis, Canada was back there within about 2 years. Okay. And so here's the big difference that happened: the affordability of housing in the United States is actually improved as a result of the global financial crisis because prices got so depressed for such a long period of time. The income to price ratio in the United States has always been significantly better over this last decade because of that significant depression. Whereas us here in Canada, we had a bit of a blip in pricing, but not a long term depression. And we just carried on in this significant appreciation, whereas wage growth has pretty much mirrored what's happened in the United States. So, from what I'm seeing, reading, and hearing, what's happened in the United States is they haven't yet felt the same impact at the household level that we have felt in Canada for all the reasons I just explained. On top of that, when you get a mortgage in the United States, you can actually lock in that rate for 30 years, right? That's a 30-year mortgage, 30-year term, 30-year amortization. Whereas here in Canada, you can get a 30-year amortization, but a 5-year term, meaning every 5 years, in the most part, you're going to have to renegotiate. And people are seeing that jump in interest rate and jump in payment. That same thing has yet to be felt to the same extent in the United States. So for these reasons, the US is doing a little better. For that reason, they're talking about holding rates higher for longer, which again means that over here in Canada, we're doing the same. But there's a lot of discussion in the world of the gurus and the economists about how much longer we are going to be coupled to the United States in terms of lockstep decision making, or are we going to divert? There are a whole bunch of other issues around that regarding currency devaluation or appreciation, rather, and therefore making our exports more expensive. But this may be a period, this next year may be a period where, at the government level, at the BOC level, maybe they reconsider how much we follow and copy the United States.
Yeah, it's an interesting point. I know I was speaking. I spent some time with one of our good friends, and Quentin. He owns hundreds and hundreds of units through apartment buildings and so forth. And I got asking him, what let's have it, Quentin. What would you do, or what could you introduce, or be a little bit different to our financing world and to the lending world? And he thought, maybe it's time we look at those 30-year terms, what they have in the States, and just trying to think outside the box. Because as you and I both said, we keep doing the same thing over and over again, and we keep running into this issue. So, and I know, of course, the U.S. has different set of financial roadblocks and hurdles, but maybe it's something that we start discussing from
Look,
lending's
I think
perspective.
we're in an environment where we cannot close the door to any option. All options should be on the table in order to create long-term housing stability for Canadians, right? So
Hmm.
if that's something that might work, give that stability, make your decision today one that you can stick to. Another really interesting thing, Gary, that came out of the United States shakedown in 2008, there was a lot of predatory lending that existed
Yes.
in that environment where people were given effectively 1 or 2% interest rates. They believed they were going to be in that particular rate for a very long time. But these tricky mortgages in the States had an escalation clause, which meant that at the end of a certain period of time, 2 or 3 years, those mortgages jumped to 8 or 9% interest rates. And, it was actually legal at the time to do that. it was very bad practice, and they really did prey on people with low financial literacy, people who wouldn't read the contract, right? A lot of people got hurt. Now, what happened in the States after that was that if you enter a mortgage, for the most part, be it fixed or variable, there is no penalty to break your mortgage in the United States.
Mhm.
So you could sign up for a 30-year mortgage, knowing that in 5 years, if you have to move to a different state or whatever, your circumstance change, you end that mortgage without a penalty. We both know that's not the case here in Canada, right? We know that the Canadian banks are set up in such a way that if you sign up for a 5 year and you get divorced and your life changes within 1 year and you have to break your mortgage, you are guaranteed to have to pay a penalty. That may be something else that they should be reconsidering, Gary. If we're going to throw everything on the table and we're going to look at the states as what is good for the consumer, trust me when I say that's probably one of the best things we could do for Canadian consumers when it comes to interest rates and mortgages.
Yeah. And let's also remind ourselves too, 8-ish years ago, 9 years ago, maybe even 10 years ago, after the financial crisis, believe it or not, and this is how short-term memory works because we forget, many countries came to Canada to learn about our financial bylaws and policies and so forth because we were able to sustain that financial crisis. Albeit this is maybe where it has become exposed. So I truthfully I truthfully do believe with a few tweaks, we can right the ship. And based on a lot of the things that the world economy came to us to figure out, well, what are they doing? Now, granted, the low interest rates has driven, quite frankly, in my belief, has driven up valuations. So
Yes.
so let's use that as a learning
Yeah.
opportunity and help
Well,
gauge that, right?
I agree. I think the thing that they really did come to Canada to explore was what was the qualifying criteria,
Mm.
the standard to which you held these borrowers, right? Because, and we've probably heard this, but in America during that time, 2006, 7, 8, they called it the Ninja loan. And Ninja is an acronym for no job, no income, and no assets, right? If you have no job, no income, or assets, you qualified for that mortgage, right? I don't think you need to be a rocket scientist to figure out that if that's your qualifying criteria, you are lending money to people who may not be able to repay that money, especially if you've got this escalation clause that jumps it up from 2% to 8%, right? But yeah, in terms of lending criteria, for sure, that makes a lot of sense. But in terms of the other side, which is that which protects the borrower, the ability to freely move between financial institutions if and when there's a better rate or a life change, I think that's something that we really should be looking at. Yes, it will affect the profitability of banks in Canada. I don't think anybody's going to cry about that other than a couple of your listeners who are maybe shareholders in said banks.
Right, right. Well, here's what I know. Here's what I know. We're not entering the storm. We are in the storm. And Dion, you are definitely in the storm where you are right now. I can hear the thunder, but that's
Oh,
all
you can
good,
hear it
man.
now? Okay.
I heard that one. That was a good one. Uh, let's kind of segue into the affordability and where Canada ranks, or some of the major cities in Canada where we rank with other world class cities. And it's
Sure.
maybe it shouldn't be surprising, but sometimes it is,
Well,
right?
Well, what I can say is usually it's good for your country to be at the top of any list, right? If it's the Olympics or something like that, that's a great thing. But this week, the Visual Capitalist, which is a great website, which basically takes economic data and puts it into infographic form, came up with their top 15 least affordable cities in the world. So let's put those up. And like you said, Gary, this may not be a surprise to people.
Here we go.
And so basically, guys, there's the top 15. And Vancouver is ranked number 3, only behind Hong Kong. And you know what? I found Hong Kong and Sydney. Sydney is the other country which I hail from in Australia. So Vancouver is third on this list. And then after Vancouver, we have Honolulu, San Jose, Los Angeles, San Francisco, uh, Auckland, New Zealand is there, Melbourne, Australia is there, and then at number 10 we have Toronto. So Number 3, Vancouver. Number 10, Toronto, in terms of housing affordability. This is measured as house price point, interest rates, and wages, right? And so basically, it's telling us all the stuff that we already know, that we are skewed in terms of our affordability. And you know what, Gary? I don't think, again, this is not something that is surprising to any of us. Uh, but it's kind of sad for it to be black and white and to be put at the top of the list here amongst all these other nations. I remember a couple of years ago looking at Hong Kong and thinking to myself, who in the world would pay that much, $1,000, $1,500 a square foot for a condominium in Hong Kong? Well, guess what? We in Toronto are now paying that and more, aren't we?
Mm-hmm.
Yeah.
Well, I'm looking at this, and Canada and Australia are usually are what am I trying to say? They're about the same size in population. Everything is about the same, although they have better swimmers than we do here in Canada. That's all I remember. The
You got better
torpedo,
hockey
remember
players,
that
don't
guy?
worry.
Yeah, yeah. But I'm looking at they have four in the top 15, four cities in the top 15 compared to our two. And if you want to kind of follow along of what Australia is doing, I know there's some really good information out there with affordability and the way that they're trying to pull that back a little bit. Do some research. It's enlightening, and maybe something that they're doing here will work. They're doing there that will work here. So there's some interesting tidbits for you.
Well, Gary, I do a lot of reading on the Australian property market because I still own property there and I have family there. So in a future episode, maybe we can make some comparisons because interestingly, Australia has effectively paused interest rates for several months in a row right now, and they do not look like they're going to increase anymore.
Hmm.
So it could be the case that Australia may be a couple of steps ahead of us in this cycle. At which point, it may be something from which we can sort of mirror and model.
Excellent. Excellent.
Yeah.
Okay. So let's kind of wrap this up with, obviously we always keep a track on the bond rates and for your everyday homeowner, that might not be very important to you, but from the grand scheme of things, as we look at purchasing or selling or refinancing, it is important and to understand of what's going on. If you have renewals coming up, we talked about this over the last several episodes, Dion. Don't just sign that paperwork, right? Ask some questions to your lenders and talk and reach out to Dion and so forth. Remind us how to get a hold of you other than what's on your shirt. I love it.
Yeah, so kangamortgage.ca is the website. And some people have asked about where to follow us on Twitter. You do it under my personal name, which is at the Dion Beg on Instagram.
There you have it, my friend. So, of course, that's Kanga Mortgage. Just reach out to Dion about any mortgage related question. Of course, he not only invests in real estate, but he speaks and walks the talk, which I love, my man. That's Dion Beg. I'm Gary McGowan. We'll see everybody real soon. Bye for now.
See you, Gary.